some of our rules and how to apply them. So if you do like this video, go ahead and show us, like it in the section down below. Drop us a subscription if you guys want to be kept updated and filled with these videos. We are aiming to bring you a new video every single day. So really, you don't want to miss it. If you're on your trading journey, there is no better YouTube out there to be. So guys, without further ado, supply and demand. What does it mean? Very simply put, supply and demand is just another word used for orders, volume, right? So anytime price goes down, that is supply entering the market. Anytime price comes up, that is demand entering the market. So the markets are a constant battle between supply and demand, buyers and sellers. But because we as smart money concept traders know that this bank is primarily controlled by large authorities, aka the bank, that there is only really one entity. And all of that selling and buying comes from one entity. So we can identify certain areas of price that still have pending orders or levels that banks need to take price back to in order to mitigate positions before continuing on. So it's our job to understand those areas, and that's what this video is about. This video is broke down into two main sequences, right? The first one is imbalance. What is imbalance? How to identify it? What does it even mean? And then the second one are our zones ourselves. And then stay around for the end of the video because I will drop a third gem, right? And it is a gem. Supply and demand. So imbalance, right? Imbalance, essentially, if you take any third candle, you take one candle, you take two candle, and then you take three candle, right? Un, dos, trois, three candles. If the wick of candle one, if price going down, if the bottom wick of candle one doesn't meet the top wick of candle three, that is called imbalance. That is inefficient price action. Price hasn't yet returned to that level. Just means it's inefficient, right? Price will always return back. That is the rule of imbalance. I mean, if you continually go and scour the market, you'll see areas in which price actually left these huge gaps. I mean, if we look at that in the actual candles themselves, let's show you what this means, right? Let's take candle one, this blue one. Let's take candle two, this black one, and let's take candle two again, this third black one. As you can very clearly see, candle one, the blue one, doesn't meet the wick, even though there is no wick, it doesn't meet candle three. So this area in between here is called imbalance. And essentially price is gonna have to come back to this point at some point to fill it. And you can see, we come back and fill it. At all points, imbalance will be filled, right? The question doesn't arise as to when it will be filled. The point is it just will be filled, always. You can go and check this for yourself, pull up a chart and you'll go and see imbalance filled. So imbalance, essentially it just means that so much volume came into the market that it was unfair, if you would like, for other participants at that point in time because they wasn't able to stack any orders. It was unfair. So we can see that we have candle one up, candle two down, candle three down. This wick doesn't meet this wick, right? This doesn't meet this. That is imbalance. Okay, candle one down, candle two down, candle three down. More imbalance from this to this. So we know that there was a large amount of volume coming into the market at this time. Now, this volume, of course, is intensive of the banks and financial institutions. The BFIs, what we call them, but you can just call them the banks. So this is where you can identify where they have got into the market and in what direction they are taking price. Because let's be honest, for the most part, they don't want to initiate such power if they don't intend on going there. So let's give you an example of imbalance. No, we have given you an example of imbalance. Now, let's give you an example of supply and demand. So, supply and demand zones, they are the zones that are responsible for producing the imbalance. So if the imbalance is the inefficient price action and it is the volume in which the banks got involved, banks have to bring price back at some point to make that price action efficient, meaning fair. So if you take a level of imbalance, and we know we have imbalance from this to this, that is imbalance. Now, what is the zone before? I like to call it the buy to sell, because price first bought and then sold, all right? That there is a level of supply. That is a zone of supply. This is also a zone of supply. Now, this zone of supply just happened to actually take out this wick, but they are both still relevant. Now, that is a level of supply. So we here at Prosperity Academy, we actually take trades out of levels of supply and target different levels, different weaker levels, right? So would we ever take this trade? No, because it doesn't meet our entire strategy, but this is just proof of supply and demand working, essentially, right? And then what does price do? Price leaves behind imbalance again, right here, in the form of a supply zone. So theoretically, could you take another trade? Yes, absolutely. Because that is the law of supply and demand, right? Take out your lows again. Okay, trade tags in. And there you go, right? Price is respecting levels of supply and demand because that is how the markets operate. So the opposite then is demand zones. And in other videos, if you guys have any questions about this video, go ahead and drop them in the comment section down below and I will cover any other videos. So demand zones then, essentially you want to be trading supply levels when price is bearish, and you want to be trading demand levels when price is bullish. So here's a random example, just a random piece of price, like literally. So we know then that we have a demand zone right here, right? Why is this a demand zone? Because it left inefficiency, right? What did it do? It also broke something. Okay, so let's see, does this level hold, yes or no? The answer to that question is a yes, right? That is the example of a demand zone, because it's just the same as a supply zone, but in the opposite effect. So why do some supply zones hold and why do some supply zones fail? Well, stick around to the end of the video and I will actually tell you why. Now I'm going to essentially explain to you what is the difference between unmitigated and mitigated. What is tradable, what is not tradable, right? Very, very simple to understand, so it should only take a second to explain. If this is a demand zone that has imbalance, that means that price has never came back to this level. Price has never revisited this level. It has inefficiency, right? The moment, and let's say you've taken a long from here. Now, the moment that price comes back to that zone, the moment that price comes back to that zone is the moment it becomes mitigated. So you can take trades from unmitigated levels, meaning areas of price that have not yet come back, But taking trades out of areas of price that have already mitigated essentially defeat the object. Why? Because every time price comes back, it gives the banks the chance, the algorithm, the chance to complete its mission, right? Fulfill the orders, close out a break even. So when that happens, it essentially becomes irrelevant, right? So break even. Essentially, it becomes irrelevant. There is no longer a need to have that level of price mapped out, right? There just isn't a need. Why? Because it's already completed its job. So we don't take trades out of levels that have already completed their job. We take trades out of levels that are essentially yet to complete their job. A perfect example of this, here we have levels of demand, that are unmitigated. Here we also have levels of demand that are unmitigated. Now, neither are right or wrong. This is a game of probabilities, right? But there are two zones, and that's what we like to see. But there are two zones here, right? That, for me, are unmitigated right now. The moment that that price comes back to them, the moment that price comes back to these zones is the moment they become mitigated. And when they become mitigated, they're essentially no longer worth trading. Doesn't mean the price can't come back again to mitigate them deeper, because the price absolutely can come back to mitigate them deeper. It can mitigate them back up to 50%. And we can take trades out of the levels based on our strategy, because what we're doing right now isn't necessarily our strategy. It's just a part of logic around our strategy, right? So that's what a supply and demand zone is. That's how they are respected. That is unmitigated versus unmitigated. Now, what makes a good zone? That is the key question. There is no point trading random levels of supply when the order flow is bullish. So if you're going to go and trade supply and demand levels alone without our course, please just make sure that you are picking zones that align with the order flow, the trend, where price is actually going. Because trying to take trades against the trend just aren't going to go very well for you. Because as a smart money trader, as a new smart money trader, your job is to position yourself in alignment with the banks. So guys, thank you very much for joining me in this video. That is all from me. If you did like this video, please go ahead and smash that like button and subscribe to the channel. Let us know in the comment section down below what you thought. And if you are looking to learn from a group of profitable traders, don't hesitate to go and check the description box down below, where we will link all of our resources, courses, PDFs, signals, and all of that good stuff.